Welcome back to Money Mind, and thank you for staying with us. U.S. citizens go to the polls on November the 8th in an election that is being closely watched around the globe. Can the Democrats retain both the House and the Senate, despite President Joe Biden's low approval ratings? Or will Republican nominees, many of whom have been backed by former President Donald Trump, lead to a red wave in both houses? Jonathan Pierce finds out how either result could impact markets and investment decisions in Asia. The U.S. midterm elections have historically been good news for global markets. That's because the election result erases much of the uncertainty over whether the U.S. president has the mandate of the people or not. And in the current economic conditions of high inflation and dampened sentiment, this could provide a boost to markets.
If you go back to midterm elections dating back to 1950, you find that the subsequent 12 months after midterm elections, gains have averaged about 15%. So that's something for investors to look forward to. But of course, in 2023, it's going to be quite different. The Federal Reserve is still fighting its battle against inflation. Interest rates are likely to hit higher. Recession concerns are still there. So, some of these concerns could potentially initially overtake, the upcycle post-midterm elections.
According to the latest polls, it seems likely that the Democrats will lose the House of Representatives to the Republicans, but retain the Senate. This would mean that the government could become deadlocked, which isn't necessarily a bad thing for markets.
Markets like it because, markets feel that sort of gridlock reduces uncertainty. Biden, he's talked about increasing the corporate tax rate. He's talked about, capital gains tax. He's talked about increasing the income tax rate and other moves that are not exactly market friendly. With the gridlock, you know that the Republicans will keep the Democrats in check, prevent them from doing anything too crazy. And the markets like that. So if you look at historically, if you look at the markets have performed the best when you have a gridlock.
It's wonderful to be together.
Experts say a deadlocked government could also mean that President Joe Biden would focus more on international issues rather than his domestic agenda.
Domestically, we would expect a pretty landlocked economic situation. And then the challenge there would be if you did have more investigations into the Biden administration coming from a divided Congress, that also just severely limits the capacity of the Biden administration to handle any economic crisis that may come along.
With the U.S. government possibly unable to make changes to economic policy, it would be left to the apolitical U.S. Federal Reserve to continue its fight against inflation and keep the U.S. out of recession.
GDP has really come off, for consecutive quarters. So this strong jobs growth ain't gonna last forever. In fact, I think once the cards start to fall, it'll be very, very rapid, and we're gonna feel it. And once that happens, consumer spending will come off. American economy, 2/3 of it is driven by the consumers. And once that goes, I think that it's very clear that it is already in recession, or they were already in recession. And if they are going to stop buying goods or going to buy far fewer goods, that is going to have a domino impact on Asia, which produces a lot of these goods.
Market watchers in Asia are paying close attention to how the U.S. midterms could impact the way the U.S. handles the current economic pressures.
When the U.S. sneezes, Asia can potentially catch a cold. If the U.S. dollar strengthens significantly, that will hurt Asia because Asian currencies will weaken. This will result in imported inflation in Asia. It will create headaches for the central banks in Asia. They will have to increase interest rates quite significantly. They will have to dip into their reserves to defend their currencies. And so, what happens in the U.S. in terms of the economy, in terms of the stock market, in terms of interest rates, in terms of the currency, the U.S. currency, will eventually trickle back down to Asia because Asia is effectively, in some ways, a mirror image of what happens in the U.S.
Another area to watch is whether a divided Congress would impact the U.S. debt limit.
There's a concern the Republicans could hold the presidential administration hostage, as it were, in negotiating if we can raise the debt limit or not. Why does that matter? Because if you don't raise the debt limit, there's a concern the U.S. defaults, and that's a huge, obviously financial crisis problem there. But why does that matter internationally? Well, if you remember, back in 2013, President Obama was meant to come out to Asia in the midst of the quote-unquote pivot to Asia for the APEC meetings. He was also on his way to see President Putin in Russia to talk about Syria issues, and he had to cancel that trip whole cloth to stay home to deal with fighting over the debt limit. So a lot of people might say that's a U.S. domestic economic issue. We're not really following it closely, but it does severely stymie the U.S. president from being able to get on with things internationally.
So what should investors do to navigate these uncertain times right now?
You can't go wrong with taking a more defensive stance. And I do know that many people are saying that, hey, you just need to continue to average down. Not a bad strategy, except that I feel that right now, given that we are nowhere, near the bottom, perhaps you can be a little bit less aggressive while averaging down. Maybe you can average down a little bit and take bite size until we are confident that the Fed is going to stop raising rates. A lot of people are going to look out for that. They're going to look out for economic green shoots. We're not talking about a recovery, a very, very convincing recovery. We're just looking for that clear, that small sign of a recovery. That's when the markets will start to shoot up. So, investors can be a little bit more aggressive when we get to that point.